All right, looks like everyone's all about here. All right, for those of you who just joined us, all right, just to make sure that you guys can hear me. If you guys can hear me and you guys can see my slides, all right, can you guys just drop me a yes, all right, in the questions tab just to let me know, all right, that you guys can hear me and see my slides, and then we can start on today's webinar on trend indicators. All right. So if you guys can hear me, you can see my slides. All right, just drop me a yes. Don't be shy. All right. Okay. Seems like you guys can hear me. That's great. All right, so without further ado, all right, let's start on today's webinar on trend indicators. All right, today's webinar will be on trend indicators. All right, I forgot to introduce myself. All right, my name is Don. I'm from Everest Fortune Group. All right, and in partnership with XM, we'll be presenting you Forex webinars. All right, and in today's webinar is on trend indicators. All right, in today's webinar mostly will be about moving averages and the MACD. All right, the moving average crossing divergence. All right, the MACD and the moving average for today's webinar. And for today's webinar, you'll be learning, like I mentioned, moving averages. All right, moving averages, how they are calculated, and how do you interpret them? How do you use them? All right, in your day-to-day trading. All right, how do you interpret moving averages? You'll also be learning about the MACD. All right, the MACD and the MACD histogram. All right, what it is, how do you interpret them? How can you use them to have a better view and a better understanding? All right, about what the market is doing. All right. So before I continue with today's slides, okay, I just want it to be an interactive session. All right. I see quite a few new names here. All right. So don't worry about it. All right. If you guys have any questions, all right, along the way as I go through the slides, don't be shy. All right. Don't be scared. Just drop me a question. All right, on the questions tab, and I will answer you directly. All right. So don't worry about it. If you guys are confused, if you guys don't really understand what's going on along the way, all right, don't be shy. I will respond to any of your questions. So just drop it in the questions tab and I will get to you immediately. All right. So if there are any questions, just drop it in the questions tab. Without further ado, all right, I will continue on today's webinar on trend indicators and specifically on moving averages. Let's start with the moving averages. All right. So what is the moving average? All right, moving averages. You guys probably use TradingView. If you are trading yourself, all right, for some time now, you would have seen this indicator, the moving average or the MA. All right, so you can see what is the moving average. It is basically a trend following indicator. All right, it helps you to smooth out the price action, helps you to filter out all the noise. All right, when you look at a graph, especially if you're trading forex, the graph can be very noisy sometimes. All right, there are lots of candles and the price seems to be chopping here and there, lots of noise in the market. So the moving average kind of helps you to filter out all that noise. All right, just get rid of all that noise, helps you to make better decisions by smoothing out the price action. All right, so that's basically what the moving average does. All right, basically the moving average, it does not predict future market action, it just follows the market action. All right, and that's what I mean when I say that the moving average is a trend following indicator. All right, it just follows the market action. All right, and I'm pretty sure I'm pretty sure there are no indicators that can accurately, all right, 100% predict future market action. All right, if there is, all right, you guys just let me know. All right, because if there are indicators that can predict future market action, you'll probably be a millionaire already. Okay, so the moving average, it does not predict future market action. All right, it just follows the market action. All right, so moving averages, they are used to identify the direction of the trend, whether it's bullish trend, a bearish trend, or there's no trend at all. All right, the market's just ranging, chopping around, not really doing much. All right, so it helps you to identify the direction of the trend. And as what a lot of people like to say, you want to trade with the trend because why? Because the trend is your friend. All right, you don't want to trade against the trend. If you want to be safe, trade in the direction of the trend, and the moving average will help you to identify that trend. And it also helps you to identify support and resistance levels. And actually, if you think about the moving average, all right, it can be viewed as a curving trend line. All right, it can be viewed as a trend line that it's not straight. It's not a straight trend line. It can be viewed as a curving trend line, meaning when price approaches the moving average, all right, it will tend to bounce or reverse depending on what the direction of the trend is. all right, whether it's a bullish trend or a bearish trend. All right, so it can be viewed as a curving trend line. That's one of the ways that I like to use moving average as well. All right, I use it as a sort of where I can see price reacting from. All right, and actually I will show you guys later on. All right, later on after I'm done with the slide, how it can be seen as a curving trend line. That's basically how I use moving averages myself most of the time as well. When I put it on my charts, I like to see it as a curving trend line. All right, so that's where I get most of the price reactions from. That's how I identify the direction of the trend. It's really, really helpful if you guys know exactly how to use the moving average. Okay, so now that you guys understand, all right, what exactly is the moving average, we're gonna have to go into some a bit of a boring part, which is the calculation part, right? So don't worry about the calculation of the moving average. Basically, there are only a few factors that you need to think about when you are calculating the moving average. And actually, depending on what software you use, all right, most of the time people will be using TradingView. All right, so the moving average will be calculated for you, and then it will be overlaid on your chart for you. So you don't need to manually calculate your moving average. All right, but this just for you to understand how the moving average is calculated, helps you to understand how we arrive at that curving line that's overlaid onto your charts. All right, this is just a good to know, but not necessarily for you to memorize and calculate by yourself. All right, usually it will be calculated for you. You just need to put in the length and all that. All right, so let's just move through this part on the calculations of the moving average. So how do you calculate a moving average? All right, for example, all right, let's say you have this graph, right, and you want to calculate a 3-day moving average. So the period, 3-period moving average, the period refers to your day, right? So 1 day is 1 period, 2 days, 2 period, and 3 days will be 3 periods. All right, so to calculate a 3-day moving average, we basically just need to add the closing prices of the last 3 days, and then you just divide it by 3, right? Average. All right, so you just need to calculate the last 3 days. So in our example, we add the closing prices of the last 3 days, which is the 20 plus 19 plus 18, and you divide it by 3, it will give you 19, right? See over here, let me just get my pen and see here, 19. Right, how do you get it? 20 plus 19 plus 18, which is the last 3 days, and then you divide it by 3. And then on the next day, right, the next day, what you're going to get is basically you just take the last 3 days again, right? So to get 18, you just take 19 plus 18 plus 17, and then you divide it by 3. And then that's how you calculate it, so on and so forth for every other day's moving average. If you are looking for a 3-day moving average, just take the past 3 days and then you divide it by 3. And if you plot these points, all right, if you plot these points on the graph, you can see how the average basically is following price. All right, you can see how it basically follows price. All right, give me a moment. I think there's something wrong with my slides. All right, here you can see, all right, the basically the moving average. If you look at the graph here, look at the graph, you can see that it's tracking the price action. All right, it's following the trend in a 3-day moving average. So if you are to calculate a 5-day moving average, all right, so your period has changed. All right, the period that you are calculating the moving average has changed. You would just average the past 5 days. All right, so a 5-day moving average. On 5th day, you have 1, 2, 3, 4, and 5. All right, the last 5 days, you divide it by 5, and that would be 18. All right, that will be your 5-day moving average. Okay, so if you were to plot it on the graph again, all right, you can see that the one that is closer to price, all right, and more sensitive to price movement, all right, let's say you plot it all out, and then you can see, all right, the red line, all right, the red line is the 5-day moving average, and the black line is the 3-day moving average. Okay, if you were to plot both on the graph, basically you can see that the shorter moving average, which in this case is the 3-day moving average, is closer to price, right? It's more sensitive to price movements, and it makes sense, right? Because you're only getting the information from the past 3 days, whereas for the 5-day moving average, you're getting it from the last 5 days. So it's not as sensitive to price movement, okay, as compared to a 3-day moving average. And of course, if you take a 1-day moving average, that's just the price. It sticks exactly to the closing price. All right. So a 3-day moving average will be slightly further, less sensitive. 5-day moving average, further, less sensitive as well, right? So on and so forth, depending on how you are calculating your moving average. All right. So that's something that you need to understand. All right, the shorter moving average, all right, the moving average with a shorter period calculated for, all right, it will be closer to price, more sensitive to the price movement. And this in this case is just a simple moving average. So that's how you get your moving average, all right, and how you can discern, all right, which one's the shorter moving average, which one's the longer moving average. All right, in the future, you might come across 50-day moving averages, all right, 100-day moving averages, 200-day moving averages. That's for really long-term price movements, and it would definitely be very far away from price, all right, not as sensitive to current, all right, price movement. Okay, so that's how you calculate your moving average, and that's how you make sense of what is overlaid onto your charts. All right, let me just remove all my drawings, and then we can move on to the next slide. Okay, so now that you have a good understanding of what a moving average is, basically you just need to understand, all right, based on how you're trading, your trading style, your time horizon, how many periods to average. All right, the critical element here is to be able to know what is the number of time periods that should be used in calculating the average. All right, do I use 5-day moving average, 10-day moving average, 50 days, 100 days, 200 days? All right, it all depends on finding a moving average that will be consistently profitable, and at the same time you want to fit the market cycle. What does that mean? All right, you want to find that time period, all right, is consistently profitable and you can follow the market cycle you wish to follow. What does that mean? It means it depends on what time horizon you're trading on. Let's say if you're a short-term trader, you're just looking for the intraday, all right, just looking for the intraday move, all right, the small bounces and the reversals on, let's say, maybe 30 minutes, 1 hour time frame. All right, you want to trade, get in, get out within a day. You can consider yourself short-term traders. All right, short-term traders tend to use 5 to 25 period averages. All right, these will stick closer to price. All right, and because you're only going for that intraday move, right, it's more relevant for you. All right, but that will change if you're a medium-term trader. All right, medium-term traders, they tend to use 26 to 49 period averages. All right, these medium-term traders, I'm talking about maybe those that trade within the week, all right, or within the month. All right, these are the traders that I'm talking about. They want to have their strategy is basically within that time horizon. All right, somewhere within the week or the month. All right, they are considered medium-term traders. All right, typically they will look at the 4-hour charts, the daily charts, these kinds of time frames. They will look at 26 to 49 period moving averages. It's more relevant to them, all right, and it doesn't stick as closely to price, all right, because remember, you are a medium-term trader, you have a medium-term horizon. Whereas if you are a long-term trader, it's really long-term, all right, you're looking on weekly charts, monthly charts, all right, your time horizon where you're holding a position is really long, maybe across several weeks, several months. You might be looking at 50-day moving averages, 100-day moving averages, 200-day moving averages. Those are the moving averages that would be more relevant to your trading strategy, all right, your time horizon that you're looking at as a trader. Okay, so remember the period of moving averages that you use basically depends on your own time horizon as a trader. When do I want to get into the market and when do I want to get out with my profits, all right, close my position. Okay, so you need to have an understanding of what kind of trading strategy you have, what kind of time horizon you have as a trader, and then you can decide on your moving average that you want to use. Okay, so that's one of the factors that you need to look at when you are looking at a moving average. Okay, and the second thing to consider is, of course, which price to average. You remember, you look at basically what a candlestick is. It has 4 different types of prices: your high, your open, your close, and your low price. All right. So which price do you want to use to average? All right, of the 4 prices. Okay. So what I have here for you, what you guys can consider, all right, most moving average calculations are based on closing prices, all right, because most people, they deem the closing price is considered to be the most important price, all right, by the majority of market participants. That's why some people just look at line graphs. They don't even look at candlestick graphs, all right. They just look at line graphs, the closing price, and they take their trades from there, right? But candlesticks are still important, of course, but the majority of market participants deem closing prices to be the strongest price, all right, the most important price. So most moving average calculations, they tend to be based on the close price. But of course, you can change that, all right, you can change that in your moving average, all right, you can construct it using the high of the period, the low of the period, the open price as well, all right, or even the median price, which is your high plus your low, and you divide it by 2, or the typical price, all right, the typical price, which is high plus low plus close, divided by 3, or the weighted close, high plus low plus close divided by 4. All right, so personally, I don't use these prices, all right, the median price, typical price, weighted close, all right, all of that. I use the closing prices, all right, because it is true that the closing price is the most important price to look at. All right, that's for me, all right, that's for me personally. When I do my own trades, right, when I place my own trades, and when I use the moving average, I use the closing prices. But it all depends on what kind of strategy you're looking at, and what kind of trades you're looking to take. All right, but for me, I use the closing price. All right, so these are the two factors that you want to look at. What's the period that you want to average? What is the price that you want to average? And you can put it into basically your moving average calculations on TradingView, all right, or whatever platform you are using. All right, and then you get the moving average, and you can overlay onto your charts. All right, so that's calculating and getting the moving average. But of course, let me just remove all this. All right, there are some criticisms. All right, the simple moving average, which is what we have been going through thus far. All right, it has some criticism. All right, the first criticism is that it only the look back period covered by the average is taken into account. And what does that mean? So basically, what people are saying is, because, say for example, you use a 10-day moving average, all right, you only look at the price from the past 10 days to plot that average in today's period. All right, so what about the prices before that period that you are looking back at? All right, how can you discern that they are not important? All right, so that's the first criticism. How do you know how to determine your look back period? All right, that is one of the criticism. Another criticism is that the simple moving average gives equal weight to each of the look back periods. So what does that mean? It means you take, for example, a 3-day moving average, or let's just go with the 10-day moving average that I've talked about. You use the 10-day moving average and you divide it by 10. What it essentially means is that every day of the last 10 days is equally weighted. All right, so that is another criticism that the simple moving average receives. All right, you give equal weight to the past 10 days. So if there's a spike, all right, that day is given equal weight compared to on a day where there's not much price movement. So that's another criticism that we have for the simple moving average. And to counter that, all right, there are actually many different types of moving averages that you can think of using, right? There are many other popular types of moving average. People don't just stick to the simple moving average. So the only significant difference between the various types of moving averages, all right, is the weight assigned to the data. Basically, it is how you give weight, all right, to the different periods and the different prices during those periods, all right. So there are many different kinds. Simple moving averages, they simply apply equal weight to all prices, all right. So if you're looking at 10-day moving average, for example, all of the 10 days will receive the same weight. That's why you just take all the prices, you add them together, and you divide it by 10, all right. So that's the simple moving average. However, there are also exponential and weighted averages, all right. These EMAs, all right, I personally use EMA as well, all right, they apply more weight to recent price. Basically means that the more recent prices, for example, if you're using a 10-day EMA, maybe the more recent prices closer to the current price are given more weight compared to the prices further in the past, right? That's what exponential and weighted averages do, all right? So, and then there are also triangular averages. All right, triangular averages apply more weight to prices in the middle of the time period, And there are also variable moving averages. All right, they change the weighting based on the volatility of prices. All right, how volatile price swings and chops around. So there are many different types of moving averages, and personally, I use the EMA, but you can try out all these different types of moving averages and see how they can be more suitable for your strategy, depending on what kind of strategy you're looking at. All right, so you can't just stick to a simple moving average and that's the be all and end all. All right, you have to explore. All right, maybe the exponential moving average is better for you. Maybe triangular averages work better in your strategy. All right, so it's always good to explore, look at the different types of moving averages before you stick with one for your strategy. All right, so that's all the types of moving averages we have. All right, let's see how we can interpret moving averages. In the first interpretation, the simplest, most popular method of interpreting a moving average, all right, is to compare the relationship between the moving average and your price. All right, that's the simple one. All right, so you can just compare the relationship between the moving average and the security's price. All right, so for example, a bullish price crossover. All right, how is that seen? You can see this is price and this is the moving average. All right, it's holding below the moving average. Every time it comes up, it reverses. All right, it's pretty much bearish. All right, the trend is pretty much bearish, holding below the moving average. All right, and that makes sense, right? Because your price is below average. All right, below the average. If you're looking at the MA in comparison to the price. All right, so when can you receive a bullish signal? Right, a bullish signal is given when prices rise above the moving average, right? So your price is above the average. See, when it cuts above, you can see basically that is your bullish signal. It means, okay, price could possibly turn bullish from now, right? You can see after that, it's pushing up much higher. So that's one way of interpreting a bullish crossover, a bullish price crossover, when price crosses above the moving average. And then there's also a bearish signal, right? Bearish price crossover. So same thing, you look at the MA and you look at the price, compare the relationship. In this case, it is bullish, right? Holding above the moving average very nicely until, of course, when prices fall below the moving average, meaning that price is falling below the average. And that's when the bearish signal is given. See, when it crosses below, it pushes lower, and that's when a bearish signal is given. Okay, so that's the first way of interpreting, all right, moving average and how you can use them to get signals, all right, bearish or bullish signals. All right, that's the first way. All right, there are of course other ways. There's second interpretation, which is the double crossover method. What is that? All right, basically we are using two moving averages to generate signals. All right, so this technique basically it is using one relatively shorter moving average and one relatively longer, right? So what does that mean? All right, a system can use maybe a 5-day moving average and a 20-day moving average. All right, it can be a short-term system, whereas you can also use 50-day moving average and a 200-day moving average for a long-term strategy. All right, the length of the moving average will define the time frame for the system. All right, so what you're doing is basically overlaying two moving averages and looking at how they interact with each other. All right, looking at how they interact with each other to generate bullish or bearish signals. All right, that's quite simple to understand. Let's look at the example. All right, so a bullish double crossover. Let's look at price. All right, you can see over here, and a bullish crossover basically occurs when the shorter moving average, it crosses above the longer one. All right, so the shorter term moving average, it crosses above a longer term moving average. That's when you generate a bullish signal. Let's say you have these two moving averages and you can see this price at this point here, right there, when the shorter term moving average crosses above the longer term moving average. So even though it's closer to price, it manages to cut above the longer term moving average. All right, it can generate a bullish signal, meaning from here, it's quite possible that price could be pushing much higher. So the crossover of the 50 moving average, of the 200 moving average, that's known as the golden cross. All right, the golden cross. Sometimes you might hear people talk about it. This is what it means. All right, when the 50-day moving average crosses above the 200-day moving average, is known as the golden cross. There's also the bearish double crossover. All right, what is that? All right, assuming the price is in an uptrend and you see the shorter average crossing below the lower one, that's when you can generate, it possibly could generate a bearish signal, meaning that price could be dropping from there. Let's look at the moving averages. All right, your first one and then the second moving average. All right, sticking closely to price, as you can see here, sticking much closely to price. However, at this spot over here, look at the black circle. All right, it manages to cross below the longer term moving average, and that's where the bearish crossover can happen. All right, so the crossover of a 50-day moving average below the 200-day moving average is known as a death cross. All right, the death cross sounds very dramatic. All right, but basically what it means is just that price could be going bearish from there, could be pushing downwards from there. All right, so that's how you use two moving averages and looking at the double crossovers to generate your bullish and your bearish signal. All right, pretty simple, pretty straightforward. Just need to look at the two moving averages and how they correspond to each other, how they react. All right. So there's another way. All right. There's also another way, the triple crossover. All right. It requires adding a third moving average. All right. So instead of two, you have three. You have three moving averages. So why would people want to have so many moving averages? All right. So basically, the third moving average, it helps to avoid false signals. All right. So sometimes when you use double crossover technique, all right, there are some false signals. If the moving average kind of chops across each other, it just keeps chopping across each other. All right, and you look at it, and if you're just using the understanding of a crossover generating bullish or bearish signals, if it just keeps chopping across each other, you just be like, oh, it's bullish, and then 2 minutes later it's bearish, it's bullish again, and it's bearish again. All right, it doesn't really make sense. There are a lot of false signals, and it doesn't do a good job of filtering out the noise, basically. All right, so the third moving average, it helps to avoid such false signals when you're using the double crossover. All right, so this popular combination, all right, some history was that it was mentioned by R.C. Allen, and he uses the 4, 9, and 18 moving day averages, all right, the moving averages combination. So, however, some traders might adjust it, all right, they might adjust it to 5, 10, and 20. All right, the 4-day will follow the trend most closely and followed by the 9 days and then the 18 days. Right, makes sense, right? From what I explained to you guys before. All right, the shorter moving average always follows the trend more closely, and then of course, the longer term moving averages, the moving averages that account for a longer period will be further away from price. All right, so let's look at the triple crossover and how you can use them. All right, so for a bullish triple crossover, all right, the appropriate alignment, let's take a look at the price. All right, let's just say it's bearish and you're looking at how it could possibly generate a bullish signal. All right, the proper alignment is for the 5-day average to be above the 10-day average, and then the 10-day needs to be above the 20-day average as well. Okay, so let's look at the three moving averages. All right, just focus on the lines. All right, just focus on the lines, and of course, the red line is the 5-day average, all right, closest to price, correct? And then the black line, the 10-day average, and then the blue line furthest away, 20-day average, of course. All right, so how can you tell, all right, the bullish triple crossover has happened? All right, you can see there. All right. All right, if the 5-day is below the 10-day average, the signal is not valid. All right. The entry is only activated when the 5-day crosses above the 10-day average, or the 10-day average is still above the 20-day average. All right. Lots of lines, but basically you just need to see the shortest term moving average. It crosses above the next shortest term. All right. Let's just say the 5-day is the shortest term, and then the 10-day is the medium term, and then the 20-day is the longest term. All right, the 5-day crosses above the 10-day, and the 10-day is still above the longest term, which is the 20-day. All right, that's when your bullish signal is generated. I know it sounds very convoluted. All right, you just need to internalize that. All right, that's how you identify a bullish triple crossover. So in this case, the 5-day crosses above the 10-day, and the 10-day is still above the 20-day average. All right. So that's how you look at a bullish triple crossover. And on the flip side, a bearish triple crossover for a sell signal, all right, in uptrend, and then you're going to look for a sell signal, all right. the 5-day will be below the 10-day, and then the 10-day is below the 20-day. So if the 10-day has just given a sell signal by crossing below the 20-day average, but the 5-day is still above the 10-day average, the signal is not valid. Right? Signal is not valid. Look at the graph. All right. So the signal isn't valid at that point. However, if the entry is, if you want to look at a real signal, all right, the entry is only activated if the 5-day crosses below the 10-day average and the 10-day average is also below the 20-day average. All right, so the 5-day average, the shortest term, it crosses below the 10-day average, which is the medium term, and then the 10-day average is also below the longest term moving average, which in this case is the 20-day moving average. All right, I know it sounds like a lot. All right, you look at, right, 2 lines is already quite confusing. You look at 3 lines, it can be even more confusing, and when you figure it out, price might already be moving. All right, so that's one of the reasons why I myself don't use triple crossovers. All right, slightly too convoluted for me. I like to stick to 1 or max 2 moving averages. Okay, so but that's basically how you look at triple crossovers. All right. So you just look at the 3 moving averages and how they respond to each other. Okay. So there are also other ways. All right. There are also the moving average ribbon. All right. It's constructed by combining 8 or more moving averages. There's lots of moving averages. All right. It captures a variety of different time cycles. All right. There's a popular combination that people that use moving average ribbon likes to look at. All right, there's popular combinations to use for short-term averages. All right, for example, 4, the 7-day, the 11-day, and the 16-day moving exponential moving averages, the EMAs. All right, so 4, 7, 11, and 16 EMA, and then for long-term averages, which is 25, 30, 35, and 40 EMA. All right, so the short-term averages basically represent short-term traders. All right, so if you look at the blue, all right, the blue lines, all right, those are the short-term EMAs. All right, and then if you look at the red lines, all right, the different shades of red, all right, those are your 4 long-term EMAs. All right, so the short-term EMAs, short-term averages, they represent short-term traders' view of the market, and the long-term averages, they basically represent long-term traders' view of the market. All right, so you look at the ribbon, all right, and you look at the 2 groups. All right, basically you're using 2 groups, so 4 short-term averages, 4 long-term averages, and they basically let you see how short-term traders are looking at the market versus how long-term traders are looking at the market, and you can judge how price could move from there, right, in response to how these moving averages are reacting with each other. Okay, so this is the moving average ribbon. All right, so there's a I want to caution you guys, all right, I want to just give you guys a caution that moving averages, remember what I mentioned at the start, moving averages are trend following indicators. All right, the trend following indicators, so there should be a bullish trend or a bearish trend that it is in place, all right, or has started before you can look at moving averages and depend on them. All right, they serve as very good trend indicators that work very well when the market is trending. For example, like that. All right, in the first part from, let's say, here. All right, from February to August, you can see very nice trend, higher highs and higher lows. All right, there's a very clear bullish uptrend. All right, this is when the moving average would be more accurate, reliable. However, from here onwards, all right, from August all the way to November in this chart, you can see that price is going sideways. All right, it's moving in a range. All right, so that's when moving averages are not very helpful. And why? Because moving averages, they work very well when the market is trending. All right, however, if the market is in a range, it can be whipsawed. All right, so if there's a clear uptrend, you can see here, whenever price pulls back, hits the moving average, it tends to rebound, it tends to bounce. All right, and then if it pushes lower again, all right, here, you see it bounce again. All right, so you can see the moving average is a lot more useful when there is a trend in place. However, if you are looking at the market in this range, all right, this range over here, it's not really very useful anymore. Remember when we say that price cuts below the moving average, all right, it should be bearish. However, that is when a bearish trend is in effect or a bearish trend is coming into effect. All right. When the market is ranging, all right, it's not very useful to use moving averages at all. All right. There are many points where price cuts the moving average without actually moving in that direction. That's what we call whipsaws. All right. The false signals when price just cuts through the moving average like it's not, like it doesn't even care. All right. It doesn't even care about the moving average. I'm going to cut below and then cut above, cut below and cut above. And that's where if you're just simply looking at moving average and determining where to buy and sell, that's where you get all your false signals. When it cuts below, you think it's bearish, and then it cuts above, then you think, oh, it's back to being bullish again. Cuts below, cuts above. And if it just keeps whipsawing, you're going to get whipsawed out of a lot of trades. Okay, so that's when you need to be clear about how to use moving average. Basically, it's much more reliable when price is in a trend, all right? When you should use them only when price is trending. Okay, you want to avoid getting whipsawed. You want to avoid getting whipsawed in a market where there's no real trend, all right, in place. All right, so just remember moving averages, they work very well when market is trending, whether it's bullish or bearish. But if it's not trending, if it's just ranging, you tend to get a lot of whipsaws, and that's when you want to basically put your moving average aside. All right, so you can't just look at moving average by itself to determine where to buy and sell. All right, you cannot just rely on one indicator. You need to have a general view. All right, use many different things. All right, Fibonacci, you can use MACD, which I'll be going through later, or you can use stochastics, all these things to help you have a bias, whether it's a bullish bias or a bearish bias. And then you look at moving average to see if it confirms your bias, and then you can use it to help you generate signals. All right, whether it's bullish signals or bearish signals, depending on whether it's a bullish or a bearish trend. All right, so you don't just look at moving average, and basically if you just look at it, there is a chance you could get whipsawed out of a lot of trades. Okay, so that's what I wanted to caution you guys. All right, moving averages, you need to have a trend in place. Okay, so now that we're done with moving average, let's look at the moving average convergence, divergence, or the MACD. All right, MACD is another indicator that lots of people they use. All right, so let's look at the MACD. MACD is yes, it's known as the MACD by a lot of traders. Moving average convergence and divergence. It was developed by Gerald Apple in the late 70s, and now it's one of the most reliable, one of the best tools that you can use to have a view of the market. All right. Basically, what a MACD is, it is a hybrid indicator that can be used as trend following, or it can even be used as a momentum indicator. All right. It offers the best of both worlds in that aspect, and we're going to take a look at how the MACD is used. Okay. So let's just look at the calculation of the MACD. All right. Just gonna see the MACD is basically made out of two plots, which is your MACD line and then your signal line. All right, so let's look at price. Let's say price is like this. You can see generally it's in an uptrend, correct? All right, so what is the MACD line? The MACD line is basically the difference between the 12-period EMA and the 26-period EMA. All right, then it will be plotted. All right, 12-period and then the 26-period EMA. And when you get the difference, you get the MACD line. And then you can plot the MACD line. All right. So when the 12-period EMA, all right, when the 12-period EMA is below the 26-period EMA, the difference between them is 100, right? When it's below, over here, you can see, right? 12-period EMA is below the 26-period EMA, the MACD will be at minus 100, correct? Because the 12-period EMA is lower than the 26-period EMA. Basically the value will be negative, all right, negative 100. All right, so when the 12-period EMA is crossing above, all right, let's get that plot there, and you can see when the 12-period EMA is crossing above the 26-period EMA, so the shorter term EMA crossing above the longer term EMA. All right, if you guys remember what I mentioned, if the shorter term is crossing above the longer term, basically it is a bullish signal, correct? So when it's crossing over, when they're equal, the MACD will be crossing the zero line. All right, so it's crossing from negative to positive territory. But at this point, it's at the zero line. And when it's crossed above, when the 12 EMA is above the 26 EMA, the difference in price is 100. And then the MACD will be at positive 100. All right. at this point over here. You can see 12 period EMA above the 26 period EMA. Now it is at positive 100. All right, so you can see there, if I were to plot positive 100, you can see, let's just look at the MACD graph. All right, when the 12 period is crossing below the 26 period, MACD is crossing the zero line to head back into negative. All right, but when the 12 period is crossing above the 26 period, generating a bullish signal, you can see the MACD basically crosses above the zero line. All right, so that's how you get your MACD line plotted on. All right, if you just to look at this part, all right, how we can generate a bullish signal from the MACD is when the MACD crosses above the zero line. It is equivalent to the 12 period crossing above the 26 period EMA, and that's when a bullish signal is generated. All right, crosses above the zero line, heads from negative to positive territory. All right, so when the 12 period crosses below, all right, when the 12 period crosses below, then it's crossing below the zero line into negative territory, and of course that would be a bearish signal. All right, we'll go through that more in detail later. All right, that's just a general way of looking at the MACD. Right. However, the MACD also has a second plot, a second line. All right, that is the signal line, which is a 9-period EMA of the MACD line as well. All right, so you take the MACD line and you apply a 9-period EMA to it. That will be the signal line. All right, signal line is this red dotted line that you see. That's basically your signal line. And don't worry about the calculations, are similar to the moving averages, whether you're using simple moving or exponential moving averages, they will be calculated for you. All right, in this case, the MACD, you don't have to adjust for the length. All right, if you just go to TradingView, put up the MACD, it will just be there for you to look at. Okay, so that's how the MACD is calculated. All right, so you have a MACD line and a signal line. So how do you interpret that? All right, first interpretation is the center line crossover or the zero line crossover, and use that for trend direction. All right, so let's look at this graph. Very, very bullish, correct? And basically what it means is what I mentioned before. When the MACD line crosses above the zero line, it is positive. All right, it moves into positive territory. That is a bullish signal. All right, MACD crosses above the zero line, holds above the zero line, price should be quite bullish. All right, and bearish center line crossover, basically when the MACD crosses below the zero line and enters negative territory. All right, that's when price is deemed to be bearish. All right, price should be dropping. Okay, so that's the first interpretation, the zero line crossover when you're looking at the MACD. Okay, and another interpretation you can look at is the signal line crossover. All right, and it's used basically for price corrections. All right, retracements from the original trend. All right, so a bullish crossover occurs when the MACD turns up and crosses above the signal line. All right, so you anticipate a potential break above the center line. All right, let's just get the signal line up there. So the bullish crossover of the MACD, when MACD line crosses above the signal line, right here. All right, when the MACD line crosses above the signal line, it's you anticipate that after that the MACD should be breaking above the zero line. All right, so MACD cross above the signal line, cross above the zero line, then you confirm, okay, price is probably going to go and be more bullish from there. All right, and similarly, the bearish crossover occurs when the MACD turns down and crosses below the signal line. All right, it crosses below the signal line. Okay, so that's where you can see at the top here, where the MACD crosses below the signal line, you expect, okay, probably it's going to cross below the zero line as well. So it crosses below the signal line, crosses below the zero line, and it should be a bearish move from there. Okay, so the MACD doesn't tell you exactly where price is going to correct itself to or where the bullish move can move to. All right, it just tells you, okay, hey, this is probably where price could be pulling back a little bit, or it could be where price is moving in that original direction. So you got to look at the MACD with respect to the price, with respect to the signal line and the zero line. All right, lots of things to look at when you look using the MACD. All right, so the MACD histogram, let's look at the MACD histogram. If you look at the MACD, put it up onto your chart on TradingView. All right, it's not just two lines, there's also a histogram. All right, the histogram was developed by a man named Mr. Thomas Asprey. He developed the MACD histogram in 1986, and what it does is basically it measures the distance between the MACD and the signal line. All right, because the MACD uses moving averages that lag price, all right? The MACD histogram basically helps to alert the chartist to an immediate signal line crossover, all right? So that's when when there's a signal line crossover, when it's going to cross over from the MACD line above the signal line or vice versa, all right? The distance between the MACD and the signal line will get smaller and smaller, all right? So that's when the histogram signals will show you that change in the distance between the MACD line and the signal line. So the histogram helps you to signal trend changes, all right, well in advance of the normal MACD signal. However, it is less reliable, so you still need to look at the MACD, all right, still need to look at the MACD, but the histogram can help you to signal, all right, give you an earlier signal, hey, you know, the distance between the MACD line and the signal line is getting smaller and smaller. You might be looking at a signal line crossover, and after that, maybe a zero line crossover as well. All right, so it gives you an earlier look into where price could be heading. All right, so the histogram is calculated. All right, basically it's just the MACD line and you subtract the signal line. All right, so the MACD histogram will be at 0. All right, when the MACD is crossing the signal line. All right, basically when the two lines intersect, all right, it's same value, you subtract them from each other, is basically 0. So let's look at that. Histogram, when it's crossing over, of course, it will be 0. All right. However, when the MACD is crossing below the signal line, that's when the histogram moves below 0. All right. You can see here. All right. Every single time when it's crossing each other, it's 0. However, it's crossing below, the MACD histogram is moving below 0. So you can see all these prices below 0. And then when it's crossing above the signal line, the histogram is going above 0. All right. Values above 0 over there. Okay. So that's when you can look at the histogram. All right. So it's referred to as MACD histogram because instead of being presented as a line, just look at horizontal bars. All right. This is basically known as a histogram. All right. So if you're looking at the MACD, you might want to look at the histogram too. All right. It could be signaling to you when the MACD and the signal line might be crossing over. All right. Might be crossing over, and then you could get an earlier signal to price changes from there. Okay. So the MACD histogram, what it does, it basically anticipates signal line crossovers. All right. When the histogram gets closer to 0, that's when you could possibly look at a signal line crossover happening in this case. All right. So you're just going to look at a histogram. All right. A downward slant. All right. Let's just pull up all the histograms first. So if you look at this downward slant, it implies negative divergence between the MACD and the signal line, and it's bearish. All right, what it means is bearish. All right, the histogram is positive, but it starts to slant downwards. All right, meaning that the space between the MACD line and the signal line is getting smaller and smaller. All right, you could be looking at MACD line crossing below the signal line and getting a bearish signal soon. All right, so an upward slant on the other hand, right, upward slant when the MACD histogram is below 0, all right, it indicates positive divergence. So it's just the histogram telling you, hey, all right, the MACD line and the signal line are getting closer and closer. You could be looking at the MACD line crossing above the signal line, and that is a bullish signal instead. All right, so that's how you look at the histogram and how the bar charts are slanting, right? Whether it's above, you look at downward slant, or it's below, you're looking at an upward slant to see when could the MACD line possibly cross the signal line, right? That's how you look at the histogram. Okay, so that's all I have for the slides. All right, I just want to show you guys how I personally use moving averages. All right, let's just pull up my own chart. Okay. Okay, if we were just to look at this graph, all right, what I like to do with my moving averages, all right, is in the length, I like to use Fibonacci numbers. All right, I like to use Fibonacci numbers when I am doing my using my moving averages. And why I like to do that is because I like to find the natural moving average. All right, so what does it mean by the natural moving average? All right, natural moving average, basically I just input the Fibonacci numbers into the length. All right, so for example, it could be any Fibonacci number, 13, it could be 21, all right, 34. Or in this case, when I'm looking at dollar yen, this is the dollar yen chart, I find that the 55 EMA is the moving average that fits closely to price. All right, it moves and it is the most receptive to price action. What do I mean by that? You can see over here, if I were to just use the pen and draw it out for you guys, you can see in this spot, when price approaches my natural moving average, all right, the 55-day moving average in this case, all right, when it's trending in an uptrend, if it pulls back to the moving average, there will be a bounce, all right, pulls back, there is another bounce, all right. So this is how I use my moving averages. In this case, the natural moving average I find to be the most useful, all right, most useful for me when I'm looking at my own charts, all right. So I just open up the EMA, all right, the exponential moving average, and of course I use the close price as I mentioned earlier, all right. So what I do in the length, all right, what is the period that I like to use my EMA? There's no fixed period, all right. You have to cycle through your Fibonacci numbers and then take a look, all right, which one responds closely to price. And of course, you want to look at when price is trending, all right. If you're looking at this part over here, you can see that price is in a range, all right. So it's not very useful anymore, all right. After it bounces, all right, here it starts to go into a range. The moving average no longer becomes useful, all right. It just keeps chopping around like what I've told you earlier, the whipsaw. It starts to chop across the chart. Very ugly movement here. That's when I know, okay, maybe the moving average is not very useful at the moment because the market is just sort of ranging, it's just sort of chopping around here. Lots of indecision, all right, inside this range. That's when I wouldn't use the moving average anymore, all right. I wouldn't use the moving average anymore, all right. However, once we move out of that, all right, and we start to see the price sort of moving in a trend again, all right, you can see when it starts to become bullish again, there will be all these reactions again, all right, because of the way it's structured, all right. You can see this reaction here, all right. It keeps on repeating itself, all right, because I'm using a natural moving average. So I don't use arbitrary numbers like 3-day moving average. I don't use like 5 days, 10 days, 50 days, all right, because if you were to ask someone, all right, why do you only take into account the last 50 days or the last 10 days or the last 5 days, all right, they wouldn't be able to give you a very good answer, all right, because it's just an arbitrary number. I like to use Fibonacci numbers instead, right? Fibonacci numbers, I cycle through them to have a better idea, all right, a better EMA that responds better to price, all right, and that's when I use these averages, and when price is indeed trending, all right, and it approaches my moving average, I expect that there should be a reaction, all right. So of course, it's not 100%, all right, it doesn't always work, all right, but more often than not, I've realized that when you're using the natural day moving average, it is very receptive to price, and when price approaches these moving averages, the natural moving average that is the fitted to the price in that sense, sort of fitted to the price, all right, you can expect that there will be reactions when price approaches these moving average. That's what I mean when it's sort of like a curving trend line, all right. When price approaches, you expect that there should be reactions. Even here, all right, you can see there are reactions. If I were to push even further back, all right, even further back to previous periods of where price was trending, you can see there will always be these reactions because of the way that I use the natural day moving average, all right, natural moving average. So if you guys would like to try it out, all right, if you guys would like to try it out, you can have a go, all right, just put up the EMA, all right, and cycle through your Fibonacci numbers. So 13, 21, 34, 55, 89, all right, all these moving averages. And of course, it depends on what kind of strategy you're using, all right, whether your horizon is long-term or short-term, all right, you might be looking at using shorter, smaller Fibonacci numbers like 13 and 21 if you are looking for shorter term trades. However, if you're looking for that long-term move, weekly moves or monthly moves, you might want to look at longer term moving averages, right? 50 days, 55 or 89-day moving averages, all right. But you can try it out, all right. I encourage you guys to try it out, all right, using the natural moving average. Just cycle through the Fibonacci numbers and just look at the areas where price is trending, all right. Look at the areas that price is trending. If price is responding nicely to the moving average, right? Whenever it comes up to the moving average, there is a reaction. It comes up, there is a reaction, and it goes in both directions as well. All right, you can see here is bearish. All right, but every time it comes up, it is reacting, coming up, react, coming up, react again. All right, until it crosses above, and then the trend changes direction. You can see there's a bounce here, sort of a bounce, small little bounce here. All right, so it works in both ways, and you tend not to get whipsawed unless you are entering this kind of ranging markets. That's when it's very dangerous. You want to look at other things like Fibonacci, like your MACD, okay, to really have a better idea of whether, okay, is the market trending or not in this case. So you only look at the moving average if the market is trending. If it's not trending, you want to avoid using the moving average. Otherwise, you just get whipsawed, all right? Like, for example, in this case over here, get whipsawed here, and then you get whipsawed again and again, all right? So you want to wait until there is a clear trend, higher highs, higher lows, and then you can look at the moving average to get a better view of where you would want to generate good signals, okay? So that's how I use the moving average, all right? That's how I use the natural moving average. And I encourage you guys, of course, just try it out, see if it works for you and your strategy. And maybe you want to incorporate it, all right? Maybe you want to incorporate it, use these moving averages in your own trading strategy. I definitely encourage you guys to try it out, okay? So that's all I have for today, all right? It's about time, all right? 11:59, all right? I still have about 1 minute, all right? So if you guys have any questions, at all about today's topic on MACD and moving averages, all right, just drop it in the comment section, all right, the question section, and I will answer them, all right? Still have about 1 minute's time, so if you have any questions, just let me know. Okay, looks like there are no questions. All right, hope you guys had a good understanding of what MACD and what the moving average is. All right, from today's webinar. All right, hope today's webinar was useful for you guys. All right, I hope you guys try out the MACD and the moving average to see whether it's fitting for you. All right, fitting for your trading strategy as well. Hope I've been useful in educating you guys about the moving average and MACD. All right, so that's all I have for today. If there are no questions, all right, I'll see you guys again soon. From Monday, Wednesday, and Friday, there will be the exclusive webinars where my colleagues will be going through the top fundamental news and the top technical setups that they have. And on Tuesdays and Thursdays, I will be in to give you guys some lessons on the Tradepedia. All right, give you guys some lessons on different types of trend indicators. We're going through support and resistance, Fibonacci, all these different concepts that can help you with your trading, right? So do tune in, all right? Do come in for our webinars, all right? So if you are unsure of the webinar schedule, just go on to xm.com and look under Forex webinars. That's where our schedule will come up, all right? So I hope see you guys again soon. All right, you're welcome, Michael. All right, I hope you have been useful in teaching you guys on moving average and MACD. All right, so if there are no other questions, all right, thank you guys for joining me on today's webinar. All right, hope that it has been useful. You're welcome, Fab. All right, I'll be with you guys again shortly. All right, I'll be with you guys again next Tuesday, so tune in for the webinar. And no other questions. All right, trade safe, stay safe, and I will see you guys again soon.